12 people sit in one room, turn one dial, and your mortgage, your car loan, and your credit card all move. They never touch your bank account. They never call your lender. Yet in 16 months, this committee took borrowing costs from near zero to over 5%. They can turn that dial the other way too. Today, exactly how it works and why almost nobody can outtrade it. Here's the number that should stop you. In 2022, inflation in the United States hit 9.1%, the highest in roughly 40 years. Prices were running away. And the people whose job is to steer that aren't politicians, aren't 1,000 bureaucrats. It's a committee of 12. Keep one question in your head. How do 12 votes move 300 million people's money? Forget money for a second and picture a thermostat. One dial that sets the temperature for an entire building. Nobody walks room to room adjusting each radiator. They set one number and warmth or cold spreads everywhere on its own. The Federal Reserve runs a thermostat exactly like this, except the temperature it controls isn't heat. It's the cost of money for the whole economy. So, what is the dial physically? It's one interest rate called the federal funds rate, the rate banks charge each other for overnight loans. That sounds tiny and technical. It is. But it's the floor the whole system stands on. Every other rate in the economy, your mortgage, your credit card, business loans, sits in the same building and drifts toward whatever temperature that one dial is set to. Now, who turns the dial? A group called the FOMC, the Federal Open Market Committee. 12 voting members, 7 governors from the Fed's board, the president of the New York Fed, and 4 regional Fed presidents who rotate in. 7 plus 1 plus 4. 12 votes. That's the whole panel that sets the temperature of American money. Not approximately 12, exactly 12. And they don't meet often. 8 scheduled meetings a year, roughly once every 6 weeks. 8 times 12 people decide which way to turn the dial. That's it. Markets worldwide, currencies, stocks, the rate on a house in a town these people will never visit, all wait on what comes out of those 8 meetings. Now, the obvious question, how does one overnight bank rate ever reach your mortgage? Here's the spread step by step. The Fed sets a target range for that overnight rate. Banks pass it along as the prime rate, the rate they charge their best customers. And card and loan rates are usually quoted as prime plus a fixed markup. So when prime moves, they move. That's how the prime rate drives credit card APRs, home equity lines, and many car loans. The dial turns, and the heat travels outward, room by room. But here's the misconception almost everyone brings, and it's the one I promised we'd settle. The Fed does not set your 30-year mortgage. A 30-year loan is paid back over decades. So lenders price in where rates are heading, not just today's rate. That's why mortgages track the 10-year Treasury yield and the markets bet on future Fed policy. The Fed's dial isn't a switch wired to your mortgage. It's the gravity the whole system falls toward. Why turn the dial at all? The Fed has 2 jobs. It's dual mandate, maximum employment, and stable prices, which it defines as about 2% inflation a year. 2% is the target temperature. Hotter than that, prices rising too fast and they cool the room. Too cold, people out of work, and they warm it back up. Everything they do bends toward that one number. The mechanism is simple once you see it. Turn the dial up, raise rates, and borrowing gets expensive. People and businesses spend less, demand cools, and inflation comes down. Turn the dial down, cut rates, and money gets cheap. People borrow, spend, hire. The economy heats back up. One dial, 2 directions, the entire cycle of boom and slowdown in a single lever. Now back to that 9.1% inflation. The room was overheating, badly. So the Fed cranked the dial harder than it had in 4 decades, from a range of 0 to 0.25% in March 2022 to 5.25% to 5.5% by July 2023. That's 525 basis points over 5 percentage points in about 16 months. And these were not the gentle quarter-point steps the Fed usually takes. 4 meetings in a row, the dial jumped 3/4 of a point each time. The biggest moves in decades. 11 hikes total. If you felt your credit card APR climb and your mortgage quote jump in that stretch, that was the heat from these 11 turns spreading through the building. But the dial isn't the only tool. There's a second one that confuses people, and it's where money seems to appear from nowhere. When the dial is already at zero and they need to push rates down further, the Fed creates new reserves, digital money, and uses it to buy treasuries and mortgage bonds. That pushes down long-term rates. It's called quantitative easing. In thermostat terms, when the dial is turned all the way down and you still need to move the temperature, the Fed quietly pumps new air into the room. Do that long enough and the Fed's holdings, its balance sheet, swell enormously. By April 2022, it had reached roughly $9 trillion, about $8.97 trillion. Money largely conjured from nothing to buy bonds. Here's where it gets personal for your money. That thermostat moves the price of literally everything. Stocks, bonds, houses. Every asset reprices when the Fed turns the dial. So, you might think the smart play is to read the Fed and trade around it. Professionals try exactly that all day with billions. And here's the twist that closes our opening loop. They lose. The evidence is brutal. Over the 15 years ending in 2024, more than 90% of U.S. large-cap active funds, run by professionals paid to beat the market, failed to beat a simple S&P 500 index. And it wasn't just large cap. No U.S. equity category had a majority of active managers beat their benchmark over 15 years. Almost nobody outtrades the environment the Fed sets. Why do they lose? Fees. A broad index fund charges almost nothing. Vanguard's S&P 500 ETF runs about 0.03%. Active funds typically charge 0.5% to over 1%. That gap looks tiny, but watch what 1% does over a lifetime. On a portfolio compounding for 40 years, a 1% annual fee can quietly eat away roughly 1/4 of your final wealth versus near zero. That's the drain that hands the index the win. Warren Buffett put $1 million on this. In 2008, he bet that a plain Vanguard index fund would beat 5 hand-picked hedge funds over 10 years. The result, by 2017, the index fund returned 126% total, about 7% a year. The hedge funds managed roughly 2% a year. Buffett won decisively and gave the winnings to charity. This wasn't always possible. Until 1976, ordinary people couldn't just buy the whole market cheaply. Then Jack Bogle launched the first index fund, now the Vanguard 500. Wall Street mocked it. It aimed to raise $150 million and pulled in just $11 million. But that one idea, owning the whole market cheaply, became an entire industry. Today, index funds and ETFs hold trillions, with global ETF assets reaching nearly $20 trillion by the end of 2025. So here's the whole picture. 12 people, 8 meetings, 1 dial. They set the temperature of money, and it spreads to your mortgage, your card, your job market, by gravity, not by switch. Quantitative easing pumps in new air when the dial hits zero. And because that thermostat moves everything, the humble move beats the clever one. Own the whole market cheaply and let it ride. Understanding the system also means understanding when people break it. The same forces we just covered, easy money, repriced assets, the hunt to beat the market, are exactly what fuel the great financial frauds. Here on Florintide, that's the other half of what we do. The full stories of Enron, Madoff's $65 billion Ponzi, the collapse of FTX, the mechanism and the crime, told properly. If this made the Federal Reserve finally click, that's the whole point of this channel. The math behind the money, made clear, plus the wild true stories of when it all goes wrong. Subscribe to Florintide for the stories and the math behind the money. Next time someone says the Fed sets your mortgage, you'll know exactly why they're wrong.